when President Trump announced 25% tariffs on all cars imported into the US from April and the same levy on car parts from May. He described them as permanent. Since then, his hard lines on trade have become increasingly blurred. But as things stand, what are the implications of the somewhat erratic US trade policy for the automotive sector, global supply chains, and the world economy?
Are Trump's tariffs steering the global auto industry into a dead end? China has officially overtaken the rest of the world to become the largest auto exporter, with some models priced as low as $9,200. It's no longer a question of if Chinese car makers will reach American shores, it's when, and tariffs won't stop them.
Back to Squawk on the Street. China is set to overtake Japan as the world's largest exporter of automobiles. Eunice Yoon joins us live from Beijing. She has more on that story. Eunice.
Thanks, David. Well, you know, China likes superlatives, and the Chinese Car Association has estimated that China, as the largest car market, is now set to become the largest car exporter. The car group had said that total auto exports up till November came in at 3.83 million and is estimated to hit 5.26 million units for the whole of last year. This is bigger than the estimate out of Japan. The one of the contributors, of course, is also Tesla, which exported 344,000 Chinese-made EVs. Now, this is all part of a result of structural issues within China. A part of that, a huge part of it, is the excess capacity. By one estimate, 25 million unused cars. This is for both combustion engine as well as EVs. And then compounding that, the economy here is slowing down. So there's a big car slump. Now,
amid an ongoing trade battle between the US and China, dominated by high tariffs and retaliatory measures, global corporations are rethinking their long-term strategies. Trump launched the trade war. The idea was clear scare companies into relocating operations to the US. But instead of folding, the world's largest automakers are pivoting, and China is becoming their new home. Ironically, companies like Toyota are now making billion-dollar bets, not in America, but in Shanghai. What was meant to be a move to pressure foreign manufacturers into choosing the United States has seemingly backfired. The expectation was that Japanese giants like Toyota and Nissan would increase US investments. But instead, they're doubling down in China, and they're not being quiet about it. These companies aren't just moving slowly or cautiously, they're boldly announcing their strategic retreat from the United States and staking out new territory in China. For Trump, this wasn't part of the plan. So how did this shift begin? Why did Toyota walk away from expanding in the United States and commit to a major project in China? And what does this signal for the future of global manufacturing? Let's unpack this move step by step. But first, don't forget to subscribe, hit the notification bell, and join our live discussion so you don't miss the most important updates shaping our world. Since 2018, the Trump administration levied heavy tariffs targeting China, intending to revive US manufacturing and attract foreign investments. The goal? Protect American jobs, outmaneuver China, and tilt the global playing field. But in practice, the strategy led companies to search for workarounds. Toyota became the prime case study. Initially cautious, Japanese firms were reluctant to respond too quickly. But as tariff tensions grew, they faced a choice: expand in America or look elsewhere. Toyota's answer came in the form of a $2 billion investment in Shanghai, a clear and calculated move toward China. Why? The growth potential in the Chinese market, coupled with strong government incentives for electric vehicles, made it the obvious choice. Even with Trump's escalating trade threats, Toyota's leadership made it clear: tariffs weren't changing their course. That $2 billion investment isn't a one-off. It marks a broader trend. Foreign direct investment into China continues, even as US-China trade friction intensifies. Unlike companies that are playing it safe, Toyota and others are taking decisive steps. In late April, the company announced its new Lexus-branded EV project in Shanghai. The massive initiative will focus on electric vehicles and batteries, aligned with China's low-carbon goals. Construction begins in June, with production set for 2027. It's being celebrated as one of the largest foreign investments in China since the trade war began. It's also a powerful vote of confidence in the Chinese market. This isn't just an isolated project. Toyota's Shanghai expansion could reshape US-China trade dynamics, especially in the auto sector. With parts and components likely to flow across borders, new logistics challenges and opportunities are arising. Yet in the background, Washington has been pressing its allies to cut trade ties with China, hinting that cooperation could lead to tariff exemptions. But companies like Toyota are standing firm. In February, Toyota stated its target: reach a production capacity of 100,000 vehicles annually and create around 1,000 jobs in China. According to Toyota Motor China's CIO, Tatsuro Ueda, the project represents a model for advancing global carbon neutrality. And Toyota isn't stopping there. The company also signed a $236 million agreement to develop hydrogen fuel cell tech with a partner in Sichuan. Even in the face of tariffs and policy uncertainty, Japanese automakers aren't willing to miss out on China's EV boom. They see strategic investment as the key to long-term success. Nissan is making similar moves. After struggling in China, its 2024 sales dropped below 700,000 units, half of what it sold 4 years ago. The company is making a comeback play. It's investing $1.4 billion into launching 10 new EVs by 2027. 8 of those models are expected by the end of 2025, ahead of schedule. Clearly, Toyota's move triggered a domino effect. Nissan, too, is refocusing on Asia. Their leadership admitted the US is no longer the default option. The industry mood is shifting. If we invest now, they say, it'll be in China. What we're seeing may be the clearest sign yet that Trump's tariff strategy has misfired. Japan's trade logic is being driven not only by tariffs but by broader structural changes in global trade. China's pull is powerful. Huge consumer demand, state subsidies, EV incentives, and tight supply chain integration make it a smart bet. Manufacturing there also means instant market access and easier exports to Southeast Asia. It's not just Japanese companies. Giants like Siemens, BASF, and Volkswagen are pouring billions into China. These multinationals don't see the trade war as a deterrent, they see it as background noise. Their message? Tariffs are temporary. China is permanent. Even as President Trump insists on balancing any rival economy, boardroom decisions tell a different story. Executives are chasing returns and resilience, not rhetoric. The evidence speaks volumes. Toyota's $2 billion investment, Nissan's $1.4 billion recovery push, Volkswagen's $2.5 billion innovation hub, Tesla's Shanghai Megapack factory in the works. All of it questions the narrative that tariffs force companies to choose America. Early in the trade war, it was assumed that Japanese automakers would boost US production. Instead, Toyota, Nissan, and Honda are pivoting to China. Why? Because building in China means lower costs, massive demand, and regional supply chain dominance. In contrast, US expansion means high labor costs, uncertain policies, and the looming threat of more tariffs. Some Japanese officials believe that the risk of losing the US market is low. American demand for Japanese cars remains strong, and even in a worst-case scenario, Japan has alternative routes to keep trade flowing. So, is the auto industry simply adapting, or is this a sign that Trump's economic nationalism has hit a wall? Let us know what you think in the comments. Do you believe this global shift will reshape the US auto market permanently? Like this video, share it, and subscribe for more deep dives into the real forces driving global change. Why Japan is choosing China over the United States and what it really means. Japan's decision to prioritize China over the United States may seem like a political message, but at its core, it's a strategic business move. The question Japanese companies are answering is simple. Where is it more advantageous to invest? The United States, while a lucrative market, presents high entry costs, especially with Trump-era tariffs still looming large, and no one knows when or if those tariffs will be lifted. China, by contrast, fiercely protects its domestic firms, yet still offers significant incentives to foreign investors, particularly in tech and electric vehicle sectors. For Japanese automakers, this opens a huge opportunity. With deep experience in hybrids and electric vehicles, brands like Toyota and Nissan stand to scale up quickly in China. That's why, despite President Trump's insistence that we will stand up to actions in the auto industry that aren't in our national interest, there's little the United States can actually do to stop this shift. Tariffs, quotas, diplomatic pressure, none of these have deterred Japan's long-term plans. So how is this trend landing with the American public? Some critics argue that the trade war has backfired, driving companies toward China instead of drawing them in. They say America failed to offer a stable, competitive climate, so Japan moved on. Others dismiss the concern, suggesting that Japan is simply acting in its own interest, and America should do the same. Still, the real impact hits the supply chain. American parts suppliers who used to collaborate with Japanese manufacturers may now find that business drifting eastward. That weakens the U.S. position in the global automotive manufacturing ecosystem. And there's a broader consequence. As Toyota and Nissan begin exporting vehicles made in China to regions like Latin America, Africa, and the Middle East, U.S. carmakers will face even tougher competition in emerging markets. It raises the question once again, what has America actually gained from this trade war? Meanwhile, other global players are doubling down on China. Volkswagen has begun building a $2.68 billion innovation center in Hefei, aiming to speed up product development by 30%. Tesla is expanding its Shanghai Giga factory and developing a $2 billion energy storage facility. Even Apple, despite diversifying to India and Vietnam, still leans heavily on China. It's not just the big names from the West. On April 3rd, Siemens Healthineers signed a deal to build its second-largest distribution and innovation hub in China, and German chemical giant BASF is investing $500 million to expand its facility in Pang, aiming to boost production by 70% by 2027, with a focus on solutions for China's booming EV sector. Why? Because China remains the world's biggest consumer base, a powerful production hub, and a key driver of global economic growth. And with electric vehicles reaching a critical tipping point, China wants to be the undisputed leader in what it calls new energy vehicles. The Chinese government has rolled out aggressive incentives to attract foreign investment while simultaneously nurturing domestic EV brands. Japan, with its proven EV and hybrid capabilities, fits perfectly into this strategy. From a business standpoint, it makes more sense to build in Shanghai or Beijing than in Detroit. Toyota executives have echoed this sentiment publicly. We want to be at the center of this transformation. In U.S. media, they're repeatedly asked, but what about U.S. tariffs? Won't this hurt your position here? Their response? We still value the U.S. market, but our future investments will focus on Asia. To counter this trend, the U.S. has tried various tactics. Increased taxes on Chinese imports, regulations on foreign goods, and generous subsidies to lure companies stateside. But it hasn't been enough. For many multinationals, the risk of losing access to China's market outweighs the sting of U.S. tariffs. Tesla, for example, could quickly lose ground to local rivals like BYD if it doesn't scale production in China. Toyota risks falling behind in the EV race if it doesn't gain a stronger foothold there. In a twist of irony, Trump's tariffs haven't driven companies away from China. They've pushed them closer. Stock markets are also responding. While Asian markets showed mixed reactions amid ongoing U.S.-China trade tensions, Japanese automakers saw gains. Toyota shares jumped 5.5% on news of its plans to acquire parts maker Toyota Industries, lifting the Nikkei 225 index. Nissan and Honda also posted smaller gains. Conversely, Chinese markets remained muted, weighed down by uncertainty in trade negotiations. The standoff between the world's two largest economies threatens to tip the U.S. into recession, even as China works to regain its footing post-pandemic. Yet Beijing remains confident. They're targeting a 5% growth rate. And so far, foreign companies seem to believe in that vision. Despite the turbulence, China's resilience is clear. By investing in innovation, promoting sustainability, and strengthening ties with global corporations, China is not just surviving this trade war. It's positioning itself as a new pillar of economic stability. In the short term, U.S. tariffs aren't steering companies away from China. If anything, they're doing the opposite. Toyota and its peers are building long-term headquarters in the heart of Asia, not temporary bases, but strategic homes for the next era of global manufacturing. As China accelerates its recovery, companies are racing to establish dominance in this massive, high-growth market. And in that race, those who move fastest and with boldness may emerge as the next global leaders. So, what's your take? Does Japan's pivot to China signal the collapse of Trump's protectionist strategy? Or is this simply a reflection of deeper, more complex global trade dynamics? Is China quietly winning the trade war by becoming the preferred destination not only for Japan but also for Germany, America, and beyond? Or will this massive shift simply create more instability and risk in global commerce? Drop your thoughts in the comments below. This is more than policy. It's the future of the global economy. Share your thoughts in the comments below and don't forget to like and subscribe now.